Now, investors at Nigeria's local equities markets appear to be unshaken by half-year earnings of banks so far as they take a risk-off disposition of bank shares. Recent contractions in the market have been largely driven by losses recorded by Zenith and Stanbic IBTC, among others. Let's get a sense of the sentiments at the market. Joining us now is Oluwadara Olunuga, analyst at ARM Securities. Oluwadara, thank you for joining us today. How would you say investors... I'd like to hear your thoughts. How do investors feel about the numbers that have been posted by banks so far?
Okay, thank you for having me, Esther. So basically what we've seen in the market is very weak sentiment towards equities, right? I mean, we are wrapping up the earnings season, and to be honest, it has been a mixed bag. So some companies have really released impressive results. Take, for instance, Okomo. I mean, we know Okomo have always thrived in terms of FX liquidity crunch, and Okomo reported impressive performance. I mean, a doubling in profit after tax, about 74% increase in revenue, which is very impressive. But sentiment has been very, very, very low. In August, the market barely made 1.6% gain, and in September is already down 0.2%. So sentiment has been very poor. The market is not really reactive to earnings results. I mean, and that's what we've seen. In the banking, it's been a mixed bag too. I mean, Stanbic released results and it's quite not impressive, not usual. The decline in revenue, very high decline in trading revenue from about 50 billion to about 4 billion. But on the other side, we have banks like Access Bank that have really done well, but it has not steered sentiment towards equities that much. Yeah. So in terms of reaction, it's been a mixed bag, but generally it's been very poor. Yeah.
But I imagine that investors are also thinking or looking at the economy, looking at macro indicators, looking for signs that the economic recovery is still picking up or maybe picking up some momentum. What are those macro indicators that investors are looking to for signs of a stronger recovery?
Yeah, so if you notice in the first half, market was was down. That's because of what was happening in the fixed income market, and then the macroeconomic indicators are very fragile. In Q2 results came out for GDP, and it's looking like market economy is back on track of recovery, but it's mainly due to base effect. Last year Q2 was the economy was down by 6%. So bouncing back by 5.1% is a base effect play. It doesn't show that the market is back on its long-term trajectory. So we would have to await what happens in Q3, and of course what is happening with the pandemic globally and even locally, the new variants. So investors are on the sidelines waiting for what will happen when you exclude the effect of the base effect one. But what's going to go forward as the economy reopens, the Delta variant and its impact on the economy. And of course, when you look at other macro indicators, inflation is trending slightly downwards, yes. But look at what is happening with FX. The liquidity crisis in the FX market is still making foreign investors stand back. And if you look at the disparity between the splits of the market between domestic and foreign investors, it's majorly a domestic economic play right now. So we have about 70% of the market commanded by local players, which will not move as much as when we have big guys from foreign investors and the funds that will push the market into the positive trajectory.
Now, while local investors, wait on the sidelines, waiting for more cues of, a stronger economic recovery, I imagine that because in the last couple of days, some stocks or even weeks, some stocks have lost some value and may present a good re-entry point, a good bargain for investors. And looking across the market, what stocks do you think present value such that investors cannot resist? What are those stocks that you think present very good bargain value for investors now?
Also, first off, the banking stocks still remain quite attractive. I mean, you would expect them to be gains from the still high yields in the economy. You take out the part of course, the regulatory aspect where nobody can predict what CBN is going to do with the banking sector. The banking stocks remain attractive. The downstream players too, they've reported impressive performance. Although prices, take for instance, Total and Adova, they reported quite impressive performance in H1, and you expect that to go into H2 because transportation has recovered, unlike what we had last year, where there was a lockdown and there wasn't movement. We've seen improvement. Of course, the oil supply too should do well because oil prices have recovered, trading at $70 per barrel. So fundamentally, some of these stocks are strong. Okomo, the downstream sector, the upstream guys, the banking sector also are quite strong because interest income is recovering and they are able to keep deposits at to retain cheaper deposits and maintain cost of funds at low levels despite regulatory issues around loan to deposit ratios. So I think we still see value in some of these stocks, and they've taken a couple of hits in. I mean, some of them are trading already below their 50-year high, and there's still opportunity for bargain hunts on those stocks.
What about for the consumer goods, especially the FMCGs? Any good bargains in that sector?
The thing about consumer goods is that the pure consumer goods, I don't really see opportunity in that line because of very low disposable income in the economy. So revenues have not been really been doing well. I mean, unless you want to go for a nesting in the consumer goods sector, which is quite highly priced. So revenues are not doing well because of low disposable income and the fact that consumers are moving towards more branded products in the consumer basket. So I wouldn't advise investment in pure consumer goods companies right now. But for breweries, still in the consumer goods basket, breweries are they are picking up volumes because of resumption in economic activities. You know, parties are already up now, and we expect volumes to recover from where they were last year. So I would say we can look at some breweries, but pure consumer goods like the likes of Unilever, PZ, I wouldn't advise investment in those stocks for now.